So welcome everyone. Brad Smith here with ACG Kentucky and currently serving as the president of our local chapter. So appreciate everyone making time to join us today for our second uh, virtual event for our local chapter. Um, so I think we'll probably have a few more people join us as we continue on, but we want, in the interest of everyone's time, we'll go ahead and start progressing. So Terry, why don't you go to the next slide? Um, just as a reminder, again, we've got some fantastic sponsors that allow our chapter to accomplish what we do on an annual basis. And so names you've seen in the past here, and they're joined by our virtual table sponsors in today's environment, and then our corporate sponsors, longstanding educational sponsors, and our longtime media sponsor. So a couple of updates to make. One I'll do, and then I'll call on my fellow board member, Darren McCauley, to make the other. So if you recall if you were with us at our last town hall, at that time, the Mid-South Capital Connection that we co-host on an annual basis with the Tennessee chapter was still pending a decision. They had decided that June wasn't going to happen this year, but we were looking at the fall. Unfortunately, just with all the logistics and still a lot of unknowns going on, the decision has been made that the Mid-South Capital Connection will be canceled for 2020. We're going to stay in kind of sequence so that instead of being in Nashville in 2021, we will move forward with our plans that we will be hosting in Louisville in June of 2021. We'll kick off that planning cycle in the fall. We'll get those dates out early in the fall so you can mark those. So look forward to being back in Louisville in June 2021 at the Marriott in Churchill Downs, and with a robust program as we always have. So then because of that, we're actually adding one more virtual event before we take the month of July off. We're going to have a town hall, much like we did in April, on June 9th at 1 p.m. We'll get a meeting notice out here this week, just kind of a save the date, so it'll be on your calendar, and more details come with that. And then as we'll take July off, and then I'll turn it over to my fellow board member, Darren, to give us an update on where we're at with our annual golf event.
Yeah, thanks, Brad. The simple answer is we're still on for Monday, August 31st, which is now Monday of Derby week. What a way to kick it off, so some excitement there. But we are going to be back at the University of Louisville Cardinal Club out in Simpsonville, afternoon event. We have not started soliciting teams or sponsorships, so don't be worried yet. I think we need to let this reopening get established before we get ahead of ourselves. But my guess is here for that June 9th meeting, coming into that June 9th meeting, we'll start reaching out to everybody and talking about teams and sponsors and finishing up the event. It's been a good event. What a way to kick it off for Derby week. So should be interesting, Brad. Thank you.
Yeah, it might be a new thing. We might have to move the timing, Darren. This might have to become an official Derby event.
Derby week event.
I mean, so we'll have to see how that works. But again, I look forward to hearing more information about that. We'll know more, as Darren said, as closer we get to June 9th. And provided we do have it, it's always a great event. So hope you'll have a chance to join us. So back in February, as we were finalizing our May event, our two guests agreed graciously to join us for the May event. We had started planning for that event, and then the world pivoted a little bit, so we've pivoted with us. So we're excited to have Terry Gill of Access Ventures and Jackson Andrews of Endeavor, the Louisville office, joining us today. Two names that most everyone on today's meeting are familiar with. Again, we've pivoted a little bit, but really to allow them to give us insight from their perspective in the private equity world and the entrepreneurial high growth world of what's happening today, and kind of some compare and contrast, as well as maybe their thoughts on the future. So we're going to kick it off, and I'm going to have Terry and Jackson just give a little more context introduction to themselves, both on a personal and a professional standpoint. So with that, I'll turn it over to Terry. Maybe you kick us off with a little background on yourself.
Thanks, Brad, and thanks, Terry, for facilitating. Thanks for the invitation. We appreciate the chance to sort of share some perspective on what is clearly, obviously, an unusual time for the whole nation, the whole world. And also appreciate the sponsors, because nothing happens without money, right? So I am currently working for CEP Holdings, a private investment holding company here in Louisville. And I started about 6 months ago working with this group. Prior to that, I spent 2.5 years in the Bevin administration. I was the Secretary of Economic Development for 2.5 years. And, you know, that was really an opportunity for me to sort of exercise my civic duty. But also it was a fascinating 2.5-year period to really understand how the private equity, or the private capital markets influence our region, our state, and how many incredible opportunities there are that are, you know, in our, we'll call the Southeast Midwestern region. So it was a wonderful perspective. Prior to that, I was actually working for a private equity group, helping one of their turn around one of the distressed assets up in Cincinnati. And then before that, I was exited a company in 2013 that I had built over about a 6-year period using different combinations of private capital. So I have been a consumer of private capital. I've been a provider of private capital. I'm in the provider stage right now, which is can be a lot more fun, maybe a little bit less stressful than being the consumer of it. But that's a little background. And I'll let Jackson take it from here.
Jackson?
Thank you to everyone, and echoing Terry's sentiments. So Jackson Andrews, I currently lead what is, at the time when we launched, only the second U.S. office for Endeavor. I helped co-found that with a number of wonderful individuals, including the great and missed David Jones Sr. of Humana, who served as our founding board chair. Endeavor operates in 40 countries around the globe, and importantly, as we were only the second at the time when we launched our office, there are now 8 U.S. offices of Endeavor. And to give you an idea of the scope of the kinds of businesses that we support, both in the U.S. and globally, last year, Endeavor entrepreneur-led businesses generated in excess of $20 billion in revenue and employ over 3 million people around the world. Our fair region is a piece of that global impact, and in many ways and in many people's eyes, you know, we are considered the leading U.S. office, and that's a reflection of the fantastic entrepreneurs and fantastic companies that are in this region. So thrilled to be here today and to talk about what entrepreneurs are experiencing firsthand, not just in the capital markets, but how they manage through crisis.
Great. So let's jump into the topic. And Terry, maybe the first question to you would be, you know, a lot of people are comparing and contrasting what we're seeing today and the economic impact that COVID-19 is having, and they're looking for various comparisons. And the most common one that comes up is looking back at 2008 and 2009, which was, you know, an last big, probably economic crisis that we went through as a country. So maybe if you could give us some insights from your perspective of the compare and contrast between that time and today. And Terry, I think, Terry McWilliams, I think Terry Gill's got a slide maybe he wants to pull up that helps paint that picture.
Yeah, this is actually a graphic that was published through Silicon Valley Bank, and I think it's a really great visual for how we view today's environment relative to the other financial crises we've experienced in recent memory. I think it's Churchill who said, you know, never let a crisis go to waste, and I think that's true. I think that if you look at what happens post-COVID, We're going to see some short-term issues that are just a function of how businesses have responded to the disruption. But we're also going to see some longer-term trends emerge, and through that disruption, that sort of creative destruction process, I think there's going to be some significant opportunity. You know, if you look at the great financial crisis, which is the GFC aftermath, you can see how and if you look at the top line of that infographic is the net internal rate of return by vintage year. And what you see is that, you know, it's sort of counterintuitive, but what happens is during these disruptions, you've got, in effect, downward pressure on valuations, right? Because, you know, risk capital is viewed differently during those time periods. And, you know, it provides for some, you know, outsized returns coming out of those crisis periods. A couple of interesting facts that sort of put it in perspective is that today, just over 40% of the unicorns, which are privately held companies that have gone through series of financing rounds, and at the current valuations, they're at least $1 billion. That's the, you know, the traditional definition of unicorn. 41% of those were founded during or in the aftermath of the great financial aftermath, that crisis period. So, you know, that's a pretty compelling argument for, you know, what comes out of this disruption. Another interesting sort of fact is that about 10% of the current listings on NASDAQ were founded between 2008 and 2012. So, you know, the challenge is, you know, getting people to sort of move in these times of crisis. And that really is a challenge for the providers of capital, because I think there's a period of time when you have to sort of move from sort of accepting the situation, understanding it's going to be here for a while, and then move into areas where you can find those opportunities for value. I think on the consumer side, the businesses that are these early stage companies that are looking for capital, it's clearly a time to understand whether or not these management teams can pivot, can understand the importance of liquidity and discipline in making difficult decisions. So you do get a chance to sort of put these management teams under some pressure and see how they respond. So, you know, we would suggest, or I would suggest that, you know, there's great opportunity out there. Clearly, if you're willing to sort of move into a more active stance, and I think the data set here sort of represents that that's been historically true.
Jackson, you want to piggyback on that maybe and talk from really the entrepreneurial standpoint and what you're seeing in the endeavor companies, both locally and kind of the insights you're gaining across the country from the entrepreneurial side of this?
Yeah, absolutely. You know, it bears kind of repeating what Terry said, transitioning into that entrepreneur side. I'm reminded of a friend of mine, Patrick McGinnis, who we had a community call with our Endeavor entrepreneurs a few weeks ago, and he's been a successful entrepreneur through the .com bubble, which if we even go back from the 08-09 period, people forget that the tech sector was down net 80% over the course of that 3-year period, but the broader indices were down 3 years in a row. So collectively, that 3-year bear market in the early thousands cumulatively was a downturn as significant as 08-09. It was drawn out. And what Patrick was talking about particularly is FOMO. And he actually is the individual that coined the term while he was at HBS, fear of missing out. And it takes courage, right? It takes courage to deploy capital in these downturns, even though we intuitively know from looking at this chart, and of course the famous Warren Buffett euphemisms, you know, be greedy when people are fearful. The folks that deploy capital and have the courage to do so will be rewarded in the long term. The numbers are just unavoidable. And the same goes for entrepreneurs. The entrepreneurs that show courage and manage through crisis will be rewarded. No great company has ever been built solely during a bull market. So this will certainly stress and end some entrepreneurs' current business, but it'll also make the very best even better. And we're seeing massive resiliency within the Endeavor network. It's actually very surprising to know that most of them are doing well, which isn't politically correct maybe to say, but they're thriving in this environment, and they're moving quickly. A great example of that is El Toro and ReadyApp, two local software businesses that are teaming up to provide corporations the ability to COVID track and contact track employees to ensure their safety, but also ensure that many of these larger older line industrial companies can get back to work at full capacity, start contributing back into the economy, and also have their employees contributing back and providing, the great work that they do. And these are companies like GE and Ford and so many others. So, those are two local examples of where companies are doing the right thing, but also providing value into a market during a dynamic period. There's a company called Listener that's headquartered in Cincinnati. They're a data over sound protocol. So they're able to beam a signal that transmits data via inaudible sound waves from device to device. Well, in a contactless world, the demand for their payment product and their software that enables that has gone through the roof, and is exploded partnerships with Visa, Paga, which is an Endeavor entrepreneur company out of Africa, out of Nigeria, that does payment processing. So these companies are providing services and answers amidst this crisis, not just regionally or even in the US, but globally. The vast majority of great entrepreneurs will navigate through this and will be so much stronger for it. So we're very bullish on what we're seeing at Endeavor and what we're seeing, these entrepreneurs kind of step up when things are down.
Jackson, you kind of bring us into the kind of current world from this slide, and we see almost daily kind of the difference geographically that COVID-19's having, both from a health standpoint, a government response. It seems to be very concentrated regionally, and a lot of times we bemoaned us setting in kind of the Midwest or flyover country or whatever people want to refer to us sometimes as,
right,
setting in the Ohio Valley. But Terry, maybe talk a little bit about what you are seeing in today's world in the private equity and the private equity's direct response, and maybe comparing, contrasting what we're seeing locally or regionally to what we're seeing on the coast.
Right. Well, let me take the sort of private equity part of that question first, and that is, clearly pre-COVID, it was a very frothy environment. I think by some estimations, there was between 1.5 trillion and $2 trillion worth of private capital that was looking to get deployed in some way, shape, or form coming into 2020. And for those members who are on the private equity side, they understand just how competitive it became, because there was this sort of a distortion between the amount of capital that was out there and the number of opportunities to participate in some of these deals. So, the result was, you saw valuations relatively high. It was a great opportunity for the business owner, because, they had a very competitive environment to sell into. And obviously that has changed. So I guess the upside, based on what side of the fence you're on, is that valuations obviously are under downward pressure. The amount of capital is still out there. So, there's going to still be a need to deploy that capital. But I think they're going to walk into, again, back to the graphic here, 2009, you start to see that inflection point. So those who are bold will, I think, be rewarded. You know, distinguishing between the venture side and the private equity side, and you know, assuming the private equity side is obviously oftentimes latter stage, it's management buyouts, things of that sort. You know, I think the reality is there was, you know, relatively cheap money before COVID, obviously, a lot of momentum in the macro economy. And I think what you might be finding, or some folks might be seeing, is that, you know, really good companies who decided to pursue kind of a build and buy strategy, maybe make some expansions, some acquisitions, and decided to lever up to do so because they could. All of a sudden, post-COVID, you know, they've got a problem that no one saw coming down the tracks. So I think that, you know, there may be some opportunities out there, obviously, for companies who otherwise have demonstrated great discipline, had good strategy. It's just they got a little bit over leveraged at the wrong time. For them, maybe who didn't necessarily want to sell, but at least maybe looking for some capital to shore up their balance sheet here in the near term. So again, just a more encouragement to the members, you know, to step into these opportunities and see what's out there. Let me answer the second part of the question, which was how does this region compare in terms of where the venture capital is flowing? And if I can get Terry to roll to that second slide, it's a good reference. Great. So this is a slide that shows exactly where the predominant amount of venture capital is deployed. And you can see 75% of that VC shows up, and I think everyone here could probably guess the markets. Obviously, it's California, high tech, software, tech-enabled businesses. You've got Boston, Route 128, right? So the pharmaceutical business, life sciences, New York and Massachusetts, I'm sorry, New York's the third one. So you've got 75% in those three coastal communities. The reality is that 75% of the GDP is generated everywhere else. And of course, you know, here we are, you know, really in the middle of the belt. You know, we often, when I was in economic development and we were traveling literally all over the world, we would oftentimes be trying to describe where Kentucky was to someone in, you know, in Korea or China or Japan or wherever we might be. And you know, we would kind of say it's really kind of the belt buckle. If you look at the expanse between Michigan and Florida, we're kind of right in the middle. And the reason we would say that is that it has, you know, tremendous assets, right? These middle market areas like Kentucky have great infrastructure and great access to major markets, but for reasons that are, you know, partly just serendipity, right? But partly just because of the bias, you see these concentrations of capital. So one of the things I failed to mention in my intro is that I'm involved with a venture growth fund that's just coming out of the ground here in Louisville. And we use this graphic to sort of make the point that there are incredible opportunities. In fact, Jackson just mentioned a few of them. These are incredibly well-managed, vibrant, younger businesses. But if you look at where the businesses that are oftentimes either created or you know, in Kentucky or in the region, you know, they tend to view their funding differently than maybe what you would see on the West Coast. You know, a lot of the companies that we see here are bootstrapped, right? So they're self-funding until they get to a point where they want to bring in some outside capital because they're at that growth inflection point. And at that point, a lot of these businesses have de-risked, right? They've proven out their product market fit. They understand their customers, and many times they're either cash flow positive or close to cash flow positive. And you know, that tends to be just sort of the good Midwestern work ethic that we oftentimes find in founder CEOs here in this region. Whereas what you might find, you know, on the West Coast or East Coast are companies that are hemorrhaging cash, right? They're still trying to figure out the business model. They're spending a tremendous amount of money. So the reason all that matters is that this is a really capital efficient part of the world. And, you know, great ideas are not, you know, only found in the West Coast or East Coast. And so we think that there's going to be more and more opportunity in the Midwest, in this region, and that's part of what we're doing at the Future Fund. And certainly, and I think Jackson's experience with Endeavor can speak to that as well. I'm sure Jackson's got some perspective on this as well. You might want to share.
Yeah, certainly. These pressures on the Silicon Valley venture capital business model were frankly already known pre-COVID, and COVID has left them totally exposed. So, the Silicon Valley venture capital model is going to be mightily tested during this, and a lot of folks aren't going to go back to it. And anecdotally, it's very interesting hearing from my relationships on the coasts, and these are great folks, but they're kind of having a come to Jesus that maybe a 10 million Series A into a company burning $2 million a month isn't a good business model. Maybe that's not how we should go about it. And so that is going to be mightily tested. It's also going to be stressing the need for geographic centralization, right? There's macroeconomic cost pressures on the coast that existed before COVID, and now they're just going to be pressured even further. There's the business model pressure of, being a capital intensive business through downturn is generally not good, right? And kind of waking up to the reality that, a long-term sustainable and big business needs to be able to navigate through these periods of time. And so those businesses are the most likely to falter during this period. The businesses with 75, 70, even 60% gross margins will be able to manage cash flow through this, whether they were venture backed or not. So I think you're going to see talent migration into various other locations within the United States. So you're going to see people shifting, and then you're also going to see capital shifting as it starts to look for more de-risked and more sustainable investments that are still into great entrepreneurs and great high growth companies. And again, if we go back to the Silicon Valley Bank slide, and you look at the great financial crisis piece, ratio of companies founded to VC funds closed, you're going to also see a huge surge in new company formation. But even though the vintages in venture capital will be the best performing, the actual amount of capital will contract a little bit. So it creates a fantastic environment and dynamic for those that do have capital or form capital to invest. And there's never going to be less opportunities than there are today, particularly in Middle America. There are only going to be more opportunities as software enables, as the capital market constraints of the Silicon Valley model put pressure on that, as the geographic pressures of living in these mega cities puts pressure. It is driving this insurgent growth in entrepreneur-led company formation and opportunities to invest in Middle America. So the future, if you look at it over a 5, 7, 10-year horizon, which is the horizon of a venture capital or private equity allocation, we're not talking about quarters. We're not talking about Jim Cramer Mad Money. Looking down the field 5, 7, 10 years, the macro and micro developments that are unfolding have never been better and are painting a pretty compelling long horizon opportunity.
That's a good segue. You kind of moved into this kind of forward looking, and clearly there's always winners and losers, and in any kind of economy. And so as we start to look forward and the engine's starting to get rev back up, hopefully, as we move into the summer and the fall and we start looking to the future, maybe Terry, you take the first crack. What you're seeing, and from a fund standpoint and just the macro economy standpoint of those opportunities that may be out there for people to be thinking about.
Well, I think the fundamental rules really haven't changed all that much. I think that you're still looking for the best example of a company operating in a growth segment. Oftentimes people are looking for just the opposite, or at least they're thinking about an interesting idea and then looking at the management team to see whether or not they can execute. I think that the smart money is kind of the opposite, right? They're looking for what are the trends that we can sort of point to as being growth areas, and then who's doing it well in the region. So I think those fundamental principles still apply. I think clearly we have seen some changes that are unlikely to revert back. Remote learning, obviously remote working, those concepts and how technologies enable businesses to operate differently. I think those are going to be with us forever. And I think what's going to happen, this certainly has happened in 2008, 2009, where, really talented people who had an idea, but maybe just didn't have that just didn't feel like it was the right time, right? And so they needed somebody to push them out the door. And circumstances being what they were, they found themselves to be a free agent with an idea, and they thought, what, now's the time. And I think that's probably what's going to happen, because there will be an influx of talent that I think we're going to see that have been disrupted because of how businesses are recovering from COVID. And I think, there's lots of speculation on what does the recovery shape look like. Is it V-shaped? Is it, on the front page of the Wall Street today, they were suggesting it's a swoosh. So I think what you're going to see is there's going to be a little bit more talent available. And I think there's going to be, more opportunities for those folks to begin to exercise their entrepreneurial idea. But I think the fundamentals are still likely unchanged in terms of how we view, or how the private markets view, opportunity, and what's the sort of right alchemy for a business that's going to attract the right kind of capital. And the other part is, I think valuations are going to continue to be depressed. That's just a byproduct of, I think, of the market conditions we're going to be dealing with for the next 6 or 12 months.
Jackson, you mentioned a couple of specific endeavor companies that are thriving right now. Other insights into whether it be specifics or more global from a sector standpoint that you're seeing?
Well, Terry touched on some of the sectors, and I think we intuitively all recognize that ed tech, remote education, telehealth is, healthcare is a slow-moving industry. This is obviously forcing its hand to adopt telehealth and other technologies that, frankly, have been around for a while, and they've just been slow to adopt and move. So it's kind of, again, the Warren Buffett saying, when the tide goes out, you find out who's swimming naked. So a lot of these older line industries are being exposed for the mass inefficiencies that they have propagated for too long. Healthcare is being forced into telehealth. The healthcare supply chain is being exposed for its inefficiencies. There's a business called Handle Global here regionally that's doing a fantastic job. It's a digital software enabled marketplace for hospitals and systems to buy and sell inventory and equipment. So it drives transparency into the healthcare equipment marketplace. That seems pretty intuitive and logical, but the existing supply chain is obviously opaque, inefficient, and lacking very much communication. Software businesses, enterprise software businesses, are also showing resiliency because they're software as a service. They are services, and they can work remote. They can probably stay remote, and in many instances, maybe will. We do think enterprise software businesses will, when budget season comes up, enterprises, large scale buyers and customers of this software, their charge has now shifted from innovation to consolidation and cost cutting. So it'll also demonstrate who is a must-have software versus nice to have, truly. And the ones that aren't must-have are going to feel some pressure, and it probably hasn't hit them yet because we haven't, by and large, hit kind of enterprise budget seasons. So even for those must-have software businesses, we're, advising, the endeavor entrepreneur companies in those spaces, be prepared for contract negotiations in the fall. You may remain a must-have, and you should remain a must-have if you're a high-value product. But as these enterprises look to consolidate, there could be price pressure on those contracts. So a lot of dynamics at play, but again, a lot of really, really bright spots. The companies we're seeing from a financing standpoint that are feeling the most pressure are those that did adopt, that Silicon Valley burn at all costs in favor of growth, that didn't get far enough along. So maybe they're a Series A, and they continue to burn cash, and their business model was just not propagated on kind of capital efficiencies. So they're going to feel a lot of pressure. The later stage companies are going to continue to get funding. The diligence process is extending out, but deals are still occurring, even though it feels like forever. It's only been a month or two. So we are seeing deals that were in the works prior still moving forward, and if not closing on pretty similar terms. We're actually not seeing, mass retrading. People are honoring their agreements within reason. There's, been some adjustments here and there. And particularly seed stage and early stage, going back to this mass ramp up in company formation, those companies are going to be, a great benefactor of this scenario. It's kind of those companies right in between, the tweeners that are neither fish nor fowl, that are going to feel a lot of capital pressure because they rely on venture capital, but their business models themselves aren't capital efficient. They didn't get to scale of an Airbnb or an Uber, which is going to continue to get support from their private backers. But if you didn't reach scale and you were a burn in favor of growth business model in this environment, we're seeing that be tough. But otherwise, looking ahead, we feel entrepreneurs are going to still be able to get funding if they've got product market fit and a good value proposition and a Midwestern venture capital business model as opposed to a Silicon Valley business model.
I'll mention one other thing real quick here, Brad, and that is, back to sort of what drives this regional economy. We are, pretty heavily reliant on manufacturing, obviously, with a great number of companies in the region supporting the automotive industry and the aerospace industry in particular, and the metals industry. And I'm on the board of a pre-revenue metals company that's looking for funding now. So what we're seeing is this response to the recognition that we had some critical items that were being procured from Asian sources. And obviously there's a lot of concern about that with PPE equipment and pharmaceutical raw ingredients. And I think what we'll see is a reshoring effort in manufacturing. Now, that's not quite as popular within the venture capital set, but maybe more so on the private equity side. But I think you're going to see more opportunities for regional companies to begin to reassess the viability of bringing some of those products back into production here in the region. And that's going to be influenced by policy, I think, largely out of DC, where there's going to be maybe some favorable policy decisions that allow some of these companies to operate in a different set of conditions. So I think that might be one of the ways for regional companies to sort of take advantage, if that's the right word, of how the company sort of emerges from the COVID crisis, and that is producing more of the products that we buy and sell here in the U.S.
Gary, maybe keep the microphone there and talk maybe any final thoughts you have around, clearly there's been disruption, but we've seen just locally and regionally, there is still success in people raising funds to deploy into the market, the work you are doing with Future Fund, some of the stuff John Wilma's done. Thoughts kind of looking into to the next 12 to 18 months around the ability to raise capital for purposes of a fund and deploying that into the market?
Yeah, I think one of the challenges that we have in a region is, we historically have not had, with some notable exceptions, we don't have a density of funds here in this region. And if you look at the continuum of funding from seed stage, angel stage, all the way through to private equity, I'll give an example. In 2007, I bought a company out of an ESOP in a leverage transaction and used a layer of mezzanine. And my choices at that point were Charlotte or St. Louis. I mean, those are the two closest sources of mezzanine capital to Louisville. And I don't know that that's any different. That's 13 years ago. So I think one of the challenges we have is we just have not, for various reasons, had a group that's been committed to raising a long-term fund in Louisville. So one of the challenges I think we just have is just that, a structural challenge. We don't have a lot of it. Therefore, those who have a willingness to devote some part of their portfolio into that alternative asset category, there aren't a lot of options here locally. So I think that's one of the challenges. We've got to understand that that there's a sort of relationship between the availability of capital and what happens, talent attraction, company formation. All of that is generally centered around the availability of capital. So I think one of the challenges we're going to have is, how do we continue to encourage more investment that is being done through local sources versus companies that originate here and recognize that in order to get their first, let's say, institutional money, they often have to pick up and relocate. And I think that's one of those questions that we need to figure out how to solve for, because I think this maybe gets back to a broader question about how do we grow as a community, and how do we grow in the across the board. And one of the things we have to figure out is how do we provide these companies with financing options here regionally. In terms of who steps into that, it's not for the faint of heart, right? And so some of it's education, and this is an organization that probably helps with some of that. But as Jackson mentioned, a lot of the companies that he's dealing with at Endeavor and that we see on our side, these are not companies that have just generated an idea on the back of a cocktail napkin. These companies have been operating for sometimes years, right? I mean, they are, they're not going to a cash flow lender in order to get growth capital. They're going to have to go to a different type of capital. But these are companies that have proven themselves to be viable and well managed. And I think that there are actually quite a few of them here. Jackson's mentioned several of them, and we just need to see greater participation, whether that's a pass the hat, right? And you're trying to syndicate a deal, or it's something like Future Fund, where it's a little bit more of a long-term commitment to providing capital to these companies. But we got to solve for that regionally.
Yeah, and pulling that out from the pure kind of parochial level of only Louisville, we're not an island unto ourselves. right? That capital gap that exists between the coasts persists across all 8 markets in which Endeavor operates. Even Atlanta, as much as that may sound counterintuitive, relatively speaking, the gap is so big. In all of these kind of middle American U.S. markets, that it really is a significant opportunity for capital providers and those with the resources to step into. I mean, it's a real big opportunity to step into because there are never going to be less great entrepreneurs and great businesses in these markets than now. There are only going to be more. And perhaps it just kind of dawned on me as Terry was thinking about how these different middle America markets view risk. Traditionally, a lot of capital finds its way into real estate investments. And lo and behold, what just became the riskiest asset you could be holding right now? Commercial real estate, where retail and customer-facing large gathering environments are going to be mightily stressed and reconfigured, and their business models and financial models. I mean, everything is up for discussion, and that may very well make the appeal of investing in a growth stage company that is cash flow positive or has line of sight to cash flow positive a pretty attractive option. So hopefully there's some psychological benefits that shift people's appetite for investing in these great companies and great entrepreneurs.
A comment, and then I'll come to Jackson for final comments from you. Terry?
Well, yeah, I think it's obviously it's a challenging environment for many of us, and I don't want to for a moment suggest that there's great clarity in terms of how long we have to sort of wait before we get to some confidence that we understand what the new normal is. But I think ultimately, it's just hugely important that we recognize that the issues that we had relative to the availability of capital and the opportunities that are presented here in the region, they were there pre-COVID. They're certainly there post-COVID. So I think if there's a takeaway here for this group, it would be recognize that you don't have to go to the coast to find great opportunities to invest in. They're literally right here in our backyard, and an encouragement that we haven't seen anyone sort of take up the mantle, if you will, from with some exceptions. John Wilmoth was mentioned. He's done a great job with his his fund, which very focused on tech-enabled businesses, and I think that what I would suggest is that it's the right time, I think, for people to begin to think about a more formal capital structure to look at either setting up an angel group here locally, or what we're doing, which is attracting capital for latter stage venture growth, some of the companies that Jackson mentioned. So just a word of encouragement that let's do it safely, obviously, but let's start making hay while the sun shines, as they say.
Jackson, final thoughts?
I would just speak to the other side of that coin, that there are great entrepreneurs and great companies everywhere, right here in our backyard of Louisville, Cincinnati, Indianapolis, but across Middle America. And there are never going to be less than there are today. There will only be more. And many of these companies will become the leading companies of the future. They will become the next Humanas, the next Procter & Gamble's, the next Eli Lilly's. That's how these movies end over a full economic cycle. So opportunity persists. There's never going to be less. There's only going to be more. And it's really inspiring every day to see all of these great entrepreneurs step up when things are down, and that's the sign of a great entrepreneur and a great company. So thank you, everyone, for having us.
Well, thanks to Terry and Jackson for investing time with us, sharing their perspective from two different sides of the table, and some cases in the middle of the table together. Say is helpful to our group. Special thanks to Terry McWilliams, who kind of the wizard behind the curtain to make this happen. And thanks
Brad,
to yeah.
And we have a gift for our speakers, so we'll be sending them the ACG
Perfect.
cup.
Great. It's a
Thank you.
coveted cup, so you know it's the first year for these, so that they might be collector's items at some point. So thanks to everyone that joined us today. Thanks to your support of the ACG Kentucky chapter. So again, everybody stay safe. Thanks for your support of the chapter, and we'll talk to you soon.